$10,000 invested in growth stocks in 2010 became $48,000 by 2024. The same $10,000 in value stocks, just $21,000. Sounds like growth wins, right? But zoom out to 1927 and value actually wins by 4.4% every single year. So which strategy is actually better? And more importantly, how do you spot the next Amazon, Tesla, or Nvidia before the crowd? The answer might surprise you. Here's what we'll cover. First, the fundamental split between value and growth, how to identify each using real metrics. The historical scoreboard since 1927, then the most important part, how to spot megatrends like Amazon, Tesla, and Nvidia before it's too late, when each strategy wins, and the real answer top investors use. There are two fundamental philosophies in investing. Value investing says, find a dollar bill selling for 50 cents, buy what's cheap, wait for the market to recognize its true worth. Growth investing says, find a dollar that's going to become $10, pay a premium today for explosive earnings tomorrow. Both strategies have made billionaires, but they approach the market in completely different ways. The most famous value investor of all time is Warren Buffett. His philosophy, price is what you pay, value is what you get. He buys companies trading below their intrinsic worth, then holds for decades. $100 invested in Berkshire Hathaway in 1965 would be worth $5.5 million today. That's a 19.8% annual return for nearly 60 years. Value investing, done right, is devastatingly effective. On the other side, you have Cathie Wood and her ARK Innovation Fund, the poster child for growth investing. In 2020, ARK returned an incredible 153%. Tesla, Roku, Zoom, all growth rockets, but then reality hit. By 2022, ARK had crashed 75%. That's growth investing's double-edged sword. The highs are intoxicating, but the lows can be devastating. Now that we understand the philosophies, how do you actually tell if a stock is a value play or a growth play? There are three key metrics that separate them. Let's break each one down with real examples. Value stocks have three telltale signs. First, a low PE ratio, typically under 15. Bank of America trades at a PE around 12. Second, high dividend yields 2 to 5%. Coca-Cola pays a 3.1% yield because it returns profits to shareholders instead of chasing growth. And third, a low price-to-book ratio, ideally under 1.5, meaning the stock trades near the actual value of the company's assets. Growth stocks are the mirror image. First, a high PE ratio, 25 or more. Nvidia trades at a PE around 60, Tesla over 300. Investors are paying a huge premium for future earnings. Second, high revenue growth, 20% or more per year. These companies reinvest every dollar back into the business instead of paying dividends. And third, zero or near zero dividend yield. Growth companies don't return cash, they burn it to grow faster. Now for the part everyone wants to know, which strategy actually wins. Let's look at nearly 100 years of data. The results are fascinating because the answer changes completely depending on your time frame. Since 1927, value stocks have beaten growth by 4.4% annually. That's an enormous edge compounded over nearly a century. If you invested $100 in each, value came out significantly ahead. But look closely at this chart, the lead changes back and forth. Value dominated from the 1940s through the 2000s. Then something happened that flipped the script entirely. From 2010 to 2024, growth absolutely crushed value. The Vanguard Growth ETF returned 47% in 2023 alone, while value managed just 9%. Over 20 years, growth returned 785% versus value's 388%. Growth dominated 8 of the last 10 years, powered by the tech boom and historically low interest rates. If you only looked at recent history, growth seems unbeatable. Here's something most people get wrong. The lines between value and growth are blurrier than you think. Apple had a PE of just 10 in 2013, that's a classic value stock. Today its PE is 32, firmly in growth territory. Stocks can switch sides, and growth doesn't always mean winning. Zoom crashed 88% from its peak. Peloton lost 97%. Growth stocks can go to the moon and then straight back to earth. Here's the most important part of this video. Forget value versus growth for a moment. The skill that creates real wealth is identifying megatrends before the rest of the market catches on. Peter Lynch, who returned 29% annually for 13 years, said it best: invest in what you know. You don't need to be first. You just need to recognize when a new technology is expanding and have the courage to invest. Let's start with Amazon. By 2010, e-commerce was only 4% of retail sales, but you could see the trend. Amazon boxes were showing up on every doorstep. Prime had 20 million members. Your friends were canceling mall trips and ordering online. If you'd invested $10,000 in Amazon in 2010, not at the IPO, just when the trend was obvious, that would be worth $330,000 today. 33 times your money. And here's the kicker. Amazon's PE was 70 the entire time. A value investor would have said it's overpriced and missed a 33x return. Now Tesla, you didn't need to buy at the 2010 IPO. The signal was in 2018 and 2019, when Model 3s started appearing in regular parking lots, not just Silicon Valley, when your neighbor got one, when Teslas went from a rare sighting to a common car. That was the business expanding right in front of your eyes. Deliveries went from 50,000 to 245,000 to 500,000. If you'd invested $10,000 when you first saw Teslas everywhere in mid-2018, that's worth $176,000 today, an 18x return. Meanwhile, short sellers who called it overpriced lost over $40 billion in 2020 alone. And now Nvidia. You didn't need to buy before ChatGPT launched on November 30th, 2022. You could have missed the very first run. But by January 2023, ChatGPT had 100 million users in just 2 months, the fastest growing app in history. By March, AI was in the news every single day. Your coworkers were using it, schools were debating it, that was your signal. If you'd invested $10,000 in Nvidia in March 2023, that's worth $80,000 today, 8 times your money in about 3 years. And here's what's incredible. Nvidia's revenue went from $27 billion to $130 billion in just 2 years. The PE actually dropped while the stock went up, because earnings grew even faster than the stock price. Here's the 5-step playbook for spotting mega trends. 1. You see it in daily life. Amazon boxes everywhere, Teslas on every road, everyone using ChatGPT. 2. Revenue is accelerating, not just growing. 3. Adoption is still early. E-commerce was only 4% in 2010. EVs were 2% in 2018. There's still massive runway ahead. 4. Ignore the PE ratio. Check the PEG ratio instead. Nvidia at a PE of 40 with 120% growth has a PEG of 0.33. That's actually screaming cheap. And 5. Hold through the volatility. Every single one of these stocks dropped 50% or more at some point. The ones who held on got rich. But here's the critical warning. Not every hype is a trend. You must know the difference between a real trend and a fad. Amazon's revenue grew 20% or more for 20 consecutive years. That's a trend. Peloton had a COVID spike, then revenue collapsed and the stock fell 97%. That's a fad. The test is simple. Is the product's usage still growing after the initial hype dies down? If your neighbors are still buying Teslas 2 years later, it's a trend. If the Peloton is gathering dust in the garage, it was a fad. Value stocks dominate in 3 specific environments. First, when interest rates are rising, like 2022, when value outperformed growth by over 20%. Rising rates crush growth stocks because their future earnings are worth less today. Second, during economic recoveries, cheap, beaten-down stocks tend to bounce back first. And third, during high inflation, value companies with real assets and steady cash flows hold their ground better. Growth stocks dominate in the opposite conditions. Low interest rates make future earnings more valuable today. That's why growth crushed value from 2010 to 2021 when rates were near zero. Technology revolutions create massive growth opportunities. E-commerce, electric vehicles, and AI have been the 3 biggest growth engines of the last 2 decades. And when central banks flood the market with cheap money, speculation runs wild and growth stocks benefit the most. Here's where things get interesting right now. The Pure Value Index trades at a PE of 13.3, almost exactly at its 15-year average of 13.4. Value is fairly priced. But the Pure Growth Index sits at a PE of 28.1, that's 20% above its 15-year average of 23.5. Growth is historically expensive. When this gap has been this wide in the past, it has often been a signal that value is about to have its turn. Here's what the best investors actually do, and it might seem too simple. They blend both. Even Warren Buffett, the king of value investing, has Apple as 40% of Berkshire's portfolio. Apple a growth stock, and he still holds Coca-Cola. The best portfolios don't pick a permanent side. They combine value stability with growth's upside, and they keep their eyes open for the next big trend. Here's how to build this in practice. For value exposure, look at ETFs like VTV, SCHD, or VOOV. They hold stable dividend-paying companies with low PE ratios. For growth, consider VUG, QQQ, or SCHG. These are packed with high-growth tech companies. Or simplest of all, a total market fund like VTI or VOO naturally blends both styles. And keep 5 to 10% of your portfolio for individual stocks when you spot a real mega trend. Let's recap the 5 things to remember. 1. Value investing means buying cheap, growth investing means buying potential. 2. Since 1927, value has the edge, but since 2010, growth has dominated thanks to tech revolutions. 3. The real skill is spotting the trend, see it in daily life, verify the revenue acceleration, check the PEG ratio. 4. Amazon returned 33x, Tesla 18x, Nvidia 8x, and you didn't need to buy on day one. You just needed to recognize the trend expanding around you. 5. Blend both strategies and keep your eyes open for the next mega trend. You don't need to be first. You need to be right. If this video helped you understand value and growth investing, smash that like button, subscribe, and share it with a friend who's trying to figure out which stocks to buy. See you in the next one.